Yo, what's going on, my peeps? Y'all know the vibes. This is David. What's going on, aka King Gradavis, up on the live. You know what I'm saying? I'm in my closet. We're gonna leave the closet jokes aside for a second. This is personally my closet because obviously, you know, wifey gotta have the big closet and whatever, you know. So this is my favorite place. I spend the most time in here. I got kind of just my clothes and not a lot, you know. But regardless, today we're gonna show you what specifically is an option contract. I'm gonna talk about a little bit, and then we're gonna show y'all some stuff. Ignore that. What is an option contract? So what you guys need to know about what is options, it's basically, how do I say this? For those of you guys that do other type of tradings, know this as kind of like your derivatives type of trading. Shout out real quick to my boy BJ, this Gucci watch by him, you know what I'm saying? Jewelry. We're gonna leave the sponsor stuff for later. But anyway, so options. So for those of you guys that have done trading before, know it as derivatives or leveraged value because it can multiply your gains and your losses by a lot. So for us to go into options, let's go a little bit back into what are stocks. Stocks is basically share values that are based on how much the company projected to output in terms of revenue or just creating its wealth. You know what I'm saying? So like,
what did he say?
A company like Apple with a $2.5 trillion, obviously their stock is going to be way higher than a company that maybe got $4 to $5 million, you know what I'm saying, in terms of yearly projected value, you know what I'm saying, in terms of valuation. And valuation is partly based on their revenue, how much they are going to make. But more so than not, valuation in the market is kind of broken right now because it's more so on what the market thinks they should be worth. You know what I'm saying? Like Tesla, projecting about $1 trillion company, you know what I'm saying? And when they got all these other cars out there, so what are they? You know what I'm saying? That's what the market wants to know and see. You know, investors can be very optimistic, but they can also be brutal too sometimes. Don't believe me? Look at GameStop and these other companies. Regardless, so it is that. So what are options? Well, if a stock price is based on how much that company produces in terms of revenue and earnings, a contract, an option contract, is based on how much that stock price is likely to be at expiration. Now, there are a couple different things when it comes to options that you need to know about. When it comes to an option contract, it's kind of an agreement between the buyer and the seller. You can sell contracts that you don't own. It's kind of like writing the contracts, you know what I'm saying? Because you kind of creating the contract. Now, you get a lot more risk in that. I'm going to go over that later. But for this video, I do want to just cover what are option contracts in a bare minimum. It's basically saying that, okay, let's use an example. Like, I'm going to give you guys a buy to open Apple $150 strike call, expiration September 17th. Depending on when you buy this, will depend on the price. But let's say it's about, right now Apple's like around 154, something like that. So let's say it's in the money. So let's say it's about $500 to buy one of these. Now, what exactly are you buying and why is it worth $500? It's not really a question that a lot of people ask, but we're gonna go on that. Because you don't need to really know it to make money, quick money right away. 80% of your option contracts, you don't need to know this stuff. But obviously, when you go broke, you want to know why. So let me show you guys. So if Apple goes up to 160, this would double. If Apple goes down and expires, this will be worth $0, below 150. The reason being so is that this guarantees that you have the right to buy 100 Apple shares at $150 each. Now, obviously, the difference between $150 and what Apple is right now will be worth how much you can think of this coupon will be worth. So this coupon theoretically will be worth $4.50, right? Theoretically, you know what I'm saying? If you were to exercise it and use that coupon to buy those shares today, yes. But because there's expiration time, there's time there as well. So there's time for Apple to move up, Apple to move down. Time is very valuable. I'm not gonna go into what can happen in a week or 2 weeks in the stock market, but it's important to understand. So, given that time, that variable in there, if Apple were to go up an extra dollar, this contract is worth 100 more because that's 100 more contracts. That's 100 more Apple shares you can, well, not 100 more. That's 100 Apple shares you can get for $1 more, and $1 times 100 is 100. So that's an extra $100 on there. Now this can be used by saying the delta of the contract, which we will get into in a later video. But basically, there's Greeks. These Greeks are important to know because they'll tell you, okay, hey, you buy it right now. It's $5, even though Apple's only at $154.50. So theoretically, it should be worth $4.50 per contract. But there's time. Now, every day you lose is a day opportunity you lose that Apple could have went up or could have went down. And this time is reflected in theta, time decay. And because you lost the opportunity of that day for Apple to continue moving up or going down, if it went down, the option contract will go down, but it will lose its value as well. Is what you can call, I believe, either intrinsic or extrinsic value, but we'll go into that in a later video. So it's going to lose it over time. So what do? Preferably sell it while you can, you know what I'm saying? But you also want to chart it, and we're going to go over that later on too. But basically, just charting the pattern and knowing, okay, is this worth to hold for later on? But basically, that is what an option contract is in its theoretical sense.